If ever there was a video where this is not financial advice, this would be the video. I'm Ryan, I'm a chartered financial advisor, and in this video, I'm going to explain to you what portfolios look like when you're constructing them in retirement. Specifically, attitude to risk, capacity for loss, asset classes, the basics of what a portfolio will look like depending on what type of investor you are, and a couple of things for you to consider. But who actually started this whole conversation? It's a guy called Harry Markowitz, a Nobel laureate back in the 1900s, and he created a literal mathematical formula to trade off risk tolerance for reward expectations. And it's what a lot of investment managers follow these days when they're looking at investments. And it's about taking just enough risk to grow, but not so much that you're forced to sell at the wrong time. And a lot of people, specifically DIY investors, and I'm talking to you if you're watching this video, you either think you leave everything in cash or you put everything into the S&P 500 or global index, and you ignore all this space in between. The reason lots of investment managers underperform the S&P, the global markets, is not because they're trash, it's because they've done it on purpose. Lots of clients, lots of investors are looking for sustainability, predictability, and reliability. Yes, 3 buzzwords. Attitude to risk, what does it actually mean? Go online and find a questionnaire from lots of websites like Standard Life, Aviva, AJ Bell. They all have questionnaires on there, you can check it out. And it's about how comfortable you are with the ups and downs of the investment markets. And then capacity for loss is about your ability to take investment risk up until the point before it damages your lifestyle or your wider overarching goals with investments and future plans. And these feed into something called volatility. And volatility is kind of like driving on a British road that's full of potholes. And it's about how dependent are you on these funds to live in retirement. And that sets the kind of main driver for how you look at your portfolios. So let's start this off. Let's look at asset classes. We've got cash, we've got government bonds, corporate bonds, we've got property, we've got equities, both small cap, large cap. Then we've got kind of concentrated equities as well as alternative and high risk investments. Now you understand the asset classes. How you construct your portfolio is dependent on the type of investor you are, but it's also dependent on purpose. Purpose is a really important thing, and I harp on about this in quite a few of my videos, especially in client meetings, because if you've got a small pension pot, your ability to bear brunt force trauma of the markets is going to be really, really low. You might be a cautious investor. You can't afford to take any risk. But if you've got a large pension pot, you might go, I'm never going to use all this money. If it's £1 million, I'm taking 3 or 4%. It's growing by X%. Realistically, it's going to serve as a nest egg to pass on my wealth to future generations. So what do portfolios actually look like? This is what a cautious portfolio looks like. And typically, yeah, you're looking for a safe bet. You're looking for low risk, but bonds can also underperform. And in recent years where we've had inflation, interest rates, everything going up and down and going crazy, we found that bonds have been really, really poor in recent years. But they're still predictable, reliable, and the UK government have never defaulted on their bonds. So a lot of people do like them. And then we've got a balanced portfolio. And this is typically what I'd expect a portfolio construction to look like for a balanced investor. This is the everyday person. This is someone who goes, I want my money to grow by inflation. Yes, I'm going to be using it a bit. And then you have the Adventurous portfolio. And again, this sums up lots of different people, specifically DIY investors. And you would expect anywhere between 80 to 95, if not 100% in equity market, taking that whole of market risk. But those that are in retirement, we typically have about 2 to 3% of their portfolio sitting in cash, depending on the size of it. Don't murder me for that comment, because we don't want them to sell and have to incur charges if there are dealing charges on their investment portfolio. That's just the way we do things. And then when it comes to considering a number of other things, a lot of people do need less than they need in retirement. I've linked a video just here on the side for you to kind of look into retirement living, comfortable type of living you might have in retirement. And that's the end of this video. I've taken a bit of time to finish this video because I got a bit of feedback saying it was too short. So I made this video slightly longer for those that wanted to hear me say good evening to them, and I wish them well.